Welcome to Investing Insights. I'm your host, Ivana Hampton. Investors' exuberance is fueling this year's stock rally, but will key economic risk dampen the market's mood? The current bull run has lifted stocks from their springtime lows to higher levels in autumn. The artificial intelligence boom is one of the big factors driving it. Meanwhile, Federal Reserve is dealing with the challenging situation of balancing the weakening job market and stubborn inflation. The Fed cut interest rates for the first time in 2025 in the third quarter, but the path forward from here is less certain. Joining me is Morningstar Inc. senior markets reporter Sarah Hansen to discuss 7 key market factors you should watch in Q4 2025. It's good to see you, Sarah.
It's great to be back. Thanks so much for having me.
You examine the highs and lows during each quarter and write about it. What do you think are the biggest takeaways from Q3?
Sure. Yeah. So my biggest takeaway, I think, for the past quarter is, especially for stocks, is just kind of the durability of the rally. The market is up about 8% over the past 3 months, and that's on top of even bigger gains in the second quarter. And that's all come after we hit the bottom in April. And so with the exception of maybe a little bit of volatility here and there, like we saw in early August, stocks have pretty steadily marched higher. A lot of that is thanks to the tech sector, but there are other areas of the market that have been rallying at the same time. I'm thinking about energy stocks, I'm thinking about utility stocks, and then small caps have also seen like a big turnaround in the third quarter too. And for the bond market, one of the biggest changes I've been tracking over the course of the quarter has been falling yields ahead of the Fed's first interest rate cut, which we got a few weeks back. That was a huge change for investors from all the volatility we saw in the bond market in the second quarter.
Well, both of those are factors we're looking at for Q4. So let's get into stocks first. Stocks are climbing higher despite a lot of risk. What signals is the market ignoring, and could it be at its own peril?
Yeah, so that's one of those questions that it's so difficult to know without the benefit of hindsight. As always with the market, it is impossible to say what's going to be the most important thing ahead of time. But you're right, there are certainly some risks to the outlook right now. One of the things that investors have been really worried about this year, all year, actually is high valuations. So when stocks are fairly valued or highly valued, as is the case with many of those big tech stocks right now, there is a lot less wiggle room for them to recover from unexpected shocks, either to the corporate outlook or to the economy as a whole or on the policy side. The counter argument to people who are worried about those high valuations is that the highest flying tech stocks are putting up strong results that kind of justify the premium on their stock prices. And, right now it's just impossible to know which of those is right. It might be that both are right. It might be we see something different. Just hard to say. Related to that is concentration risk, which is not new, but which is still around. Those tech stocks like Nvidia, the Microsofts, the Amazons, Meta, those stocks comprise an unusually large share right now of the stock market by weight. And so the risk is that if they struggle, they could bring the rest of the market down with them. And then other risks have to do with the economy more broadly. I'm thinking about elevated inflation thanks to tariffs. I'm thinking about a weaker labor market. And both of those things could mean kind of slower growth down the line, which would be a risk for stocks. But so far, stocks don't really seem to be worried about that yet. We're kind of marching higher anyway. The recent Fed cut likely helped investors feel a little bit better, but some strategists have warned that the market probably expects more cuts than the Fed will deliver, given the ongoing risk from inflation. So that'll be something to watch too.
The AI boom is driving what's going on in the market. Mega cap tech companies like you just named are making these huge investments. Where's the money going, and how long is this level of spending expected to continue?
Yeah, so this actually ties really well into those risks that we just talked about. A lot of the biggest winners in the market this year and over the past few months have been those AI stocks like Nvidia. And investors just can't seem to get enough of them. There's enormous demand for AI technology. And as a result, there's enormous demand for the infrastructure that makes AI possible, the building blocks. So like cloud computing resources, data centers, storage, semiconductor chips. And a lot of the money being invested in AI right now is being used for those things. That's what analysts call capital expenditures or CapEx. The worry is that the money pouring into into the industry will dry up, or that the growth expectations for all this investment are too bullish. But right now, Morningstar analysts are pretty bullish themselves. They don't really expect AI spending by the world's biggest tech companies to slow down anytime soon. The rate of growth in percentage terms could slow a little bit as those companies get bigger, but overall, the dollars invested, Morningstar thinks those are going to keep growing, and that's a bullish sign.
The hot IPO market has benefited from AI. Some of the most successful IPOs this year involve the industry. Can you describe this revival?
Yeah, absolutely. So this has been a big change from 2024 and even from earlier this spring. AI and tech have been part of this huge resurgence in new companies going public over the last couple of months. There's been a really strong demand from investors for companies exposed to these industries. As the stock market has soared since the spring, companies have gotten more confident. We've seen pretty major IPOs from tech players and AI players like CoreWeave, Figma, Klarna, and Chime, which are fintech companies. And then there were some pretty notable crypto companies too. I'm thinking about Circle, Gemini, Bullish. Some of those names have performed kind of better than others. Some saw really strong pops and then kind of faded away. Others saw a slower start and then have grown. But all the buzz is certainly an indication of a really strong investor appetite overall for these kinds of companies.
The first interest rate cut of 2025 is in the books. The Federal Reserve pointed to the softening job market as one reason for the move. What are strategists telling you as the market awaits the Fed's next move?
Yeah, so we had our first rate cut in a full year a few weeks ago at the Fed's September meeting. That cut was not a surprise to anyone. It was well priced into the market. Everybody kind of knew it was coming. Even though inflation is still, as we mentioned, like a little bit higher than the Fed would prefer, we had a few months showing kind of increasing weakness in the labor market, and that was enough for central bankers to loosen policy a little bit. But the most interesting part, more interesting than the cut, I think, of the meeting a few weeks ago, was the projections that we got from members of the Fed committee. These come out quarterly. It contains, a collection of expectations for inflation, the labor market, interest rates going forward. And this time around, there was a really, really wide range of forecasts, which is kind of unusual. And it tells us that Fed officials don't see one clear path for policy or the economy. And that's something that they're going to have to juggle in the months ahead. At the same time, they have this kind of undercurrent of political pressure and kind of heightened scrutiny that's making things even more complicated. As far as the next couple months, I think we're pretty confident that we'll have one or two more cuts this year, depending. But the picture moving into 2026 is a little bit less clear, and I think it will really depend on the path of the economy.
Let's stick with inflation because it's still not tamed and it's hovering above that 2% target that the Fed has. There are expectations that tariffs could raise prices for a while. What are the outlooks from Morningstar and other strategists?
Yeah, so this has been one of the big questions about tariffs, starting from when they first kind of came into the conversation and through till now, is how much pressure they will put on prices and how long that pressure will last. In general, economists agree that tariffs will make inflation higher. They will put upward pressure there. Jay Powell at the Fed has described tariffs as causing a one-time price increase, but not a all-at-once price increase, which means that the effect will kind of be dragged out over time because supply chains are complex. The tariffs were rolled out slowly, industry by industry, and they're being kind of adjusted as we go. And it will take businesses in different industries different amounts of time to adjust. But in general, both at Morningstar and elsewhere, analysts expect inflation to kind of peak somewhere either in the fourth quarter or in 2026 and then kind of fade back away. So PCE inflation, which is what the Fed uses, came in at 2.7% at the most recent reading, which was for August. That's above the Fed's 2% target. Morningstar expects that number to average about 3% in 2026 and then fall lower after that.
Now, as the Fed cuts rates, short-term yields will come down. What about the rest of the bond market? Where do people see the risk?
Yeah. So on the shorter end, like you mentioned, those rates tend to follow the Fed. The Fed has the biggest impact on bonds with shorter maturities, about 2 years and shorter. And as the risk with those, before we get to long term, is that investors who hold cash or shorter dated securities will see yields on those products come down very quickly as the Fed starts to lower rates. And then longer term bonds, on the other hand, are much more sensitive to market conditions. Those are like expectations for economic growth or inflation, concerns about the deficit over the longer term, kind of the bigger existential things those are the things that weigh on those long rates. And analysts expect those long rates right now to kind of remain a little bit elevated, given that inflation is still sticky. We still have a lot of policy uncertainty, both when it comes to tariffs and otherwise. And so when you have higher yields on your long-term bonds, you can earn a little more coupon as a bond investor, but your prices will be lower. And then at the same time, there's a potential for more volatility, which is never fun in the bond market. And that's certainly something we saw in like 20 and 30-year bonds earlier this spring, in the aftermath of when the tariffs were first announced and ahead of the passage of the tax bill. We saw some really big swings in that part of the market. And so to balance those two risks, strategists have been saying this for some months now, but they often advocate for a position in bonds kind of somewhere in the middle of the two ends of the spectrum. They call it the belly of the yield curve. And it's bonds with maturities between about 5 and 7 years, kind of helps you get the benefit of the higher yields, but you avoid big interest rate risk on the long end, and you avoid kind of the risk that your yields will drop very, very quickly on the short end.
Well, let's shift to what's going on in the nation's capital. The federal funding fight is continuing in D.C., and I want to timestamp this moment because it is Tuesday, September 30th, just after 12 o'clock. The U.S. government would shut down on October 1st if there's not an agreement. How does this uncertainty affect the markets, and what should investors think?
Right. So this is a tricky one. I feel like you and I always talk ahead of some very uncertain
We do.
policy announcement. So it's Tuesday afternoon to timestamp. It's September 30th. As of right now, as far as I know, we do not have a deal to keep the government open to pass a budget bill that everybody's happy with. And, as always, when it comes to these things, the picture can change really quickly. But for now, we could have a government shutdown at midnight. In general, for investors, as far as thinking about these things, shutdowns are nothing new. We've had a bunch of them over the past couple decades, and typically the market doesn't tend to react too strongly over the long term. In the short term, there could be some kind of volatility, losses across stocks. We could see treasury yields come up a little bit, but over a longer term perspective, the impact is generally pretty minimal. What could make this time different, and again, we don't know, but what could make it different this time is the possibility of kind of major layoffs of federal workers if this happens, rather than furloughs, which is what typically happens. If the layoffs that are being discussed are permanent, that could have a much more lasting impact on markets and on economic growth. That could have a bigger impact on the markets. We don't know what it'll look like yet and if it'll happen. And as always for investors, this is why it's really, really important to keep a long-term perspective in mind. Reacting really quickly to events like this by making changes or trying to time events like this is generally not a winning strategy for portfolios. It's much better to have a well-diversified portfolio, a disciplined strategy, something that's designed to withstand news events like these so that you can sleep at night and don't have to worry about checking in on your accounts at 9 a.m. on October 1st.
Sarah, earnings season is coming up in a couple of weeks. What is your team watching for?
Yeah, so we'll start hearing from companies about their third quarter results in just a few weeks, beginning with the big banks. Analysts right now overall are looking for about 8% earnings growth across the S&P 500, which is pretty good. The the second quarter, saw almost 12% growth. But estimates are often kind of revised downward ahead of reporting season, and then they kind of creep back up as companies start to release their results. The tech sector especially is expected to do pretty well, like it has all year. And then, so the big risk here, of course, is that companies don't deliver on those expectations, which could always happen. With stocks fully valued, like we talked about, there isn't a lot of room to recover if results don't look great. And, just like last quarter, we will be watching pretty closely for clues about how US firms are reacting to tariffs, how much of the extra costs they are taking on, and how much of those costs they're passing on to consumers. And then lastly, I might be paying attention to clues about hiring and firing, given the labor market. Listening to see if on earnings calls companies give us an idea about how they're thinking about their workforce and what might that mean for the economy.
Well, we covered a lot today. Leave us
Yes,
with
we
the
did.
takeaway for investors as we enter Q4.
Yeah, it's again, no one has a crystal ball when it comes to the market. These things are super hard to predict. I think the takeaway for me is to be prepared for a little bit of volatility. Strategists have been saying this all year, and I think it still holds true for us right now. Most people are pretty constructive on the outlook. Despite all those risks we talk about, strategists think overall the fundamentals look okay, at least for now. But even if that's the case, markets rarely go up in a straight line. And so there could certainly be some bumps in the road as we approach the end of the year. And I think that's really important for investors to keep in mind.
Well, Sarah, thank you for your time today and breaking down the key market factors to watch in Q4.
Thanks so much for having me.
It's time to discuss a few of the biggest market headlines. Dan Kemp is the Chief Research and Investment Officer at Morningstar Investment Management Europe. He also writes the weekly Markets Brief column on Morningstar.com, and he's coming to us from London to share his insights. I'm glad you're back, Dan.
Ivana, it's so good to be back with you.
Well, we talked on last week's Investing Insights about inflation. The Federal Reserve's preferred tracker showed inflation slightly ticked up in August, as forecasters expected. It also revealed consumer spending rose. What do you think that's signaling about the U.S. economy?
Well, yes, you're absolutely right. There were really two things going on last week in economic land. The first was that PCE measure of inflation, which showed that the inflation in the economy is still running higher than the target by the Fed. And so that should be a concern, but it was as expected. And normally investors respond calmly when data is as expected. They tend only to change their minds when there's a surprise. There was no surprise, and so that was a pretty calm response. But what was less well reported was an increase in the estimate of last quarter's GDP, economic growth, from 3.3% annualized to 3.8%. That's a big uplift. And as you said, that was driven by consumer spending. So that would indicate that the economy is actually stronger than we're currently seeing in other pieces of data. So that wasn't very well reported, but it is quite important.
And in this week's Markets Brief, you highlighted Nvidia's potentially record-breaking investment. The chipmaker announced that it would invest up to $100 billion in OpenAI. How should investors think about this deal?
$100 billion. It's such a huge amount of money. And in fact, as you say, it would be a record-breaking deal for any investment in a venture capital-backed business. And OpenAI already hold that record because of a fundraising they did earlier this year that raised $40 billion. So these are huge sums that are being invested in AI. And the challenge for investors is that there's two very simple narratives we have to be aware of. The first simple narrative is that there's far too much money being invested in this technology, and we've seen these investment booms in the past, and often they've led to investment busts because there's been too much investment and not enough consumption of the new technology. And so that's an easy narrative. The other easy narrative is that AI has changed everything, including the rules of investment and return, and to some extent economics. And So we can have these huge investments and still maintain those valuations and the ongoing forward progress of these companies. Both of those are simple. They will appeal to some people, but from an investor's perspective, we have to think about all of the other possible outcomes around those two simple narratives. We have to think about investment maybe being slightly above or slightly below what the opportunity demands. And so it's not as straightforward to say there's one outcome or even two outcomes from this huge fundraising we're seeing. The future is likely to be much more complicated than that, and investors need to think about a range of outcomes when making decisions.
And new economic data is due out this week. What are you tracking for next week's Markets Brief?
Well, yes. So the big news at the beginning of this week, of course, is going to be the potential for a US federal government shutdown. That's at the top of everyone's minds. Now, as investors think about the impact of the shutdown, it's really important to remember that although there will be an immediate impact, a lot of this is gradually washed through later on when the government opens up again and back pay is paid. And it's still a worry. Particularly in a very febrile political atmosphere. So we shouldn't discount it entirely, but it's probably not such a big economic event as most people are worrying about if it happens. If it doesn't happen, if we get a continuing resolution, then really the focus is going to be on jobs numbers on Friday. Pretty modest expectations currently baked in, about 45,000 new jobs, no real increase in unemployment. That reflects weaker job numbers we've seen over the last couple of quarters. But if we do get a big difference from that, then we can expect prices to move. And that's where clients need to be really careful about not jumping to conclusions on one set of data.
Everyone listening, watching, we are recording this episode on Monday, September 29th, just after 10 a.m. Be sure to check out Dan's must-read Markets Brief column on Morningstar.com on Mondays. Thank you, Dan, for joining me on the podcast.
Thank you.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Giving Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to Senior Video Producer Jake Van Kersen, Supervising Video Producer Roberto Iacurci, and Associate Multimedia Editor Jessica Bevel. I'm Ivana Hampton, Lead Multimedia Editor at Morningstar. Take care.